Good morning, students. The last lesson we discussed about the standardized approach to capital calculation methodology with a varying risk weights for different asset classes from 0 to 20 to 50 to 70 for retail portfolio and 100 unrated corporate exposures, 150, up to 150% risk weights for the non-performing loans, etc. Another approach is called foundation internal risk rating based approach. What is the risk rating based? In the developed markets like US and European countries, there are risk rating available for the corporate entities invariably. Ratings given by the internationally accredited institutions like Moody's, Standard & Poor's, Fitch rating agencies, like that. Accordingly, Basel has stipulated each bank has to develop their own internal risk rating model along with enterprise-wide risk management framework and the best corporate governance practices in place, like that, to enhance and tighten the risk management processes. Accordingly, each bank will have internal ratings for the borrowers from 1 to 7 or 8 or 9 or 10. As per Basel, minimum risk rates each bank is supposed to have is 7, including non-performing grades. But in practice, many banks have developed more than the minimum required number of grades, and accordingly, they have developed probability of default rates for each grade. Lower the probability of default grade for the superior ratings. So accordingly, probability of default is the internal input of each bank, and the central bank of that jurisdiction are giving other inputs like LGD, loss given default. Loss given default, in average, they give, for example, 70% of the probability of default. And also EAD, they call it the exposure, call it EAD, exposure at default, like that. So multiply all these factors, you will get the capital, directly required capital instead of risk weightings. This is a bit advanced level, which banks are supposed to implement. So in the next lesson, we will discuss in detail. Thank you.